good to go here. Looks like we've already started recording. We'll delete the first part of that, Steve. So, once again, Brian Wilson here. We're very thankful that you're here with us today. Today is July 10th, and we'll go ahead and get started. Lots to unpack. Just a couple of rules as we proceed today. If you would just kindly mute yourself as we proceed. And then, happy to unpack any questions that you might have. Part of what we'll discuss today, a little bit of like, let's call it classroom type stuff at the beginning. A couple of things with the 4 different behaviors that we have in the marketplace. And we'll talk a little bit about ETFs. We'll talk about where we're at right now. So a lot to unpack, but once again, I'm thrilled that you're here joining us today. Since I'm by myself today, I'll probably go about 3 or 4 minutes at a stretch. Turn off the screen share, see if any questions have come in. And by the way, feel free to toss any questions there in the chat room if you want. So with that, we'll go ahead and do the screen share and go ahead and get started. By the way, this is Lake Louise in Banff. If you've never been to Banff, absolutely incredible place. I went in the summer with my wife about 6 years ago, so thoroughly enjoyed that. As we get started, I wanted to, and let me make sure that no one else is coming in here for a second. Sorry about that. I'll have to go back if I hear the beep, I guess. So I want to start with I want to start with the different behaviors in the marketplace. So this is the world that everyone's used to. This is the world that I was used to as a buy-side trader back in the day. It was a world where active money dominated, and this is the world that most forwards still believe is the case. It's the world that basically CNBC leads us to believe is the case. This is the world as it is right now. So what this means is that active money takes up about 10% of daily trading levels. Fast trading, about 46%, passive money, about 25%, and risk management, about 19%. Now, one thing to think about in terms of these different behaviors is they're all buying and selling for different reasons. So active money cares about the fundamentals of a stock. That's why they're going in. They're very well versed on earnings and EBITDA and everything else that goes into the fundamentals. But recognize that trading on a daily basis only makes up about a tenth of the activity. On the passive investment side, it's about 25% of daily trading, and passive money cares about characteristics. So when we mention characteristics, think about things like market cap, sector, volatility. That's what we're talking about regarding characteristics. They will lump a given equity into a basket based on those characteristics. Fast traders trying to profit on price differences in securities, posting bids and offers, and then trading trends during the course of the day. If at all possible, trying to be flat by the end of the day. In the risk management portion, I mentioned this in today's note, looking at things like options, forwards, futures. What are market participants doing to leverage or protect with derivatives itself? So there's 4 types of money, and it's very different than the world that most everyone is familiar with. Everyone still thinks it's active money moving the market. That's no longer the case. There's 4 different behaviors in the market, and each one has a different reason why they're buying or selling. Let me stop my screen share for just a moment, see if any questions have come in. If we're good, I'll just go ahead and continue. So 4 different behaviors in the marketplace itself. That takes us to what I was discussing this morning with the expirations cycles. Let me take you to a slide here that deals with expirations. So this was as of June 25th. And let me enlarge this. So June 25th, back last year. And what we're looking at here is the derivatives market. Over 580 trillion of notional value derivatives as a total. Equity contracts, 7.8 trillion total. US equities, about 4.1. I looked up the most recent information. This was June 25th, and it looks like we're continuing to grow there. And I think this was the end of the year annual report. Look at the growth. So up to 8.9 for total equity linked contracts, up to 4.7 for US equities. So we're talking trillions of dollars, and we're talking what's happening between options expiration cycles. So all of this money is moving in the market, in the derivatives market. Some of it is daily contracts, some of it is weekly, but the majority of it is on the monthly contracts itself. And a good way to look at it is to examine just some of the recent trends that we've seen. If we go back the last 6 months or so, we'll get a pretty good example of why expirations can be inflection points. Here's a perfect example going back to February. Look at upside, and what you're looking at here, this is the SPY. This is market structure sentiment in green. That's our algorithm for demand. And down below is market short volume. So inflection point activity right at expirations, the whole market starts to come under pressure. And you can see it repeatedly here. We get to expirations in March. Market had been under a little pressure. We get some upside afterwards. Here's the example that really drove gains over the last couple of months. We had pressure into April expirations. What happens afterwards? Well, tremendous upside. We have a little bit of choppy trading coming into June expirations. What do we get afterwards? We get upside. So expirations itself can be inflection points for the market. We see it over and over again. Part of the reason for that, you think about what the money is doing. And once again, we'll move back here for a second. You have about 19% of daily trading that's making decisions regarding leverage and hedges. What do they want to do with that, with their contracts? Are some of those things getting too expensive now? Do they want to kind of up the ante? So all these decisions are being made across the market. And once again, when we consider the impact in the US equity market, it's about $4.7 trillion. So it's a lot of money, and it's part of the reason that we see some of this movement around expirations itself. I'll stop my screen share here for a second. Any questions coming in so far, or are we pretty good? Just raise your hand or feel free to go off mute if you do have anything. Well, we will continue then. I wanted to go to a section in regards to ETFs. So you guys are very well versed in ETFs, much more so than the average investor. This is part of a class that we do for our investor relations side. Modern IR is the name of our sister company. And it's just a good review for a moment. Why do ETFs exist in the marketplace? Well, the stock market itself has limited supply. Most shares are owned by investors who don't sell. But we have a lot of people who want to invest in US stocks. So what do? Well, we create a substitute for stocks, and we call it ETFs, which actually equals collateral. How ETF shares are created, we won't go into that right now. But as you're aware, ETF shares trade like stocks. It gives investors exposure to the same stocks other investors own. It's at a lower cost. It's at better liquidity. Right away, you can see why some of the active investor funds get driven out of the market. They are at higher cost. They have worse liquidity. The bad part about ETFs, well, they have no intrinsic value and they may be collateralized by stocks somebody else actually owns. So when we talk about that collateral process, what are we actually talking about? Well, ETFs themselves are actually a sampling of stocks, not the whole index. And that takes a lot of people by surprise. So if you have an S&P 500 ETF, that ETF is not necessarily owning all 500 components. It's difficult to do so. It's expensive to do so. So they will take a sampling of that. Or they might even take borrowed stocks. They might take stocks owned by a single large investor, stocks owned by the ETF sponsor itself. A lot of times we'll see collateral being done by cash. But what you see then is in the market is you see these inflationary effects over time. Let's take a quick review of what the market looks like right now. So this is a review, and it's good information about the growth of ETFs. This is coming from Investment Company Institute 2024. So over $10 trillion in 2024. This is all the different instruments, large cap domestic, other domestic, global, international bond, hybrid as well. If we have all of those lumped together, about 3,600 instruments. If we look at just the equity ETFs themselves, and this was an AI answer that I searched before the call here, 2963 was what they came up with. And I think that's pretty close to being accurate. Guess how many public companies are in the equity universe? About that number, about 2,900. Let me show you what that looks like. As you know, that continues to shrink over time. This is what it looks like here, where passive money continues to grow, active money continues to shrink. So the ETF universe continues to move higher over time. If we look at which companies tend to benefit, well, 85% of the Wilshire funds, Wilshire 5000, is in 443 stocks. 9,800 is in about 1,500 stocks, and 95% of the Russell 3000 is in 1,000 stocks. So as you're very familiar, we talk about it from time to time, especially with our big tech portfolio. Everything is heavily slanted towards the big guys. Wilshire 5000 over time, back in the late 90s when I started my buy-side trading career, we had over 7,000 public companies. That right now has shrunk to a little over 3,000, but many of them are almost non-tradable, just with the size of the actual companies. So what we see over time, and you guys see this in the headlines all the time, is more money will chase fewer goods. The big get bigger, the small just end up dying, and the market concentrates into the largest stocks. So you have these inflationary effects from ETFs. And going back to that ETF discussion one more time here, What we will then see over time is ETFs drive the market higher. And at some point, there tends to be a little bit of a pause. I think we saw that a couple of days ago. This is straight out of a Vanguard ETF fact and straight out of a State Street one. So look at what the ETFs can do on their side. They can use in-kind redemptions to remove stocks that have greatly increased in value. So from a public company perspective, they're moving higher. Everything's great. All of a sudden, they become part of the redemption basket. Why is that? Well, the ETF plan sponsors getting rid of capital gains. It's something that their contemporaries on the mutual fund side can't do. It's an advantage of ETFs. Very similar from State Street, the trust will not recognize gain or loss for U.S. federal income taxes on in-kind distributions and redemption of creation units. Take a look at the SPY recently and take a peek at what was happening here. So this is a report that we run on the Modern IR side. Look at the money that was funneling into the market. We had, what is that, 3, 4, 5, 6, 7, 9 days in a row where we closed above midpoint pricing, huge gains there in the market, moving from, let's call it 595 or so, north of 620. What behavior was driving those gains? What you're looking at here, if you're above the zero axis, that means greater influence from that behavior. That's passive money. A lot of ETFs. What did we have for a couple of days? We had a pause in the market. What did that likely represent? Probably ETFs that were getting rid of capital gains. So we got rid of some of those capital gains, sets kind of a new base, and then money can start coming back in again. Look at that money on the passive investment side, 25% versus norms of about 19%. So we're familiar with ETFs, but just as a reminder, they have an inflationary effect on the stock market because you have you have a finite amount of companies, and we have ETFs that are expanding all the time. Yes, Brad, that's correct. A lot of those companies, though, are over the counter. So if you have an ETF, Brad's question, sorry, you can't see that if it's in the meeting chat. He's asking about the number of companies across the New York Stock Exchanges, NASDAQ, NYSE, et cetera, over 8,000 listed companies. A lot of those are over the counter, where ETFs and other market professionals, you really can't even get into some of those smaller companies to establish any type of position. You would move those company shares so much it would be almost impossible to do. So any other questions about what we've been covering so far? If not, let's take a peek at what we're seeing in the SPY. We kind of hinted at this already. There's been a tremendous amount of money that's been flowing in. This is a year-to-date look at trading activity. So this is the SPY. What you're looking at is the greatest influences. Once again, if you're above the zero axis, that reflects greater influence on trading. So as the market was moving higher before the tariff-related pressures, you can see passive money having the greatest impact. In fact, if you look at all of these periods, it follows a pretty similar pattern. Passive money tends to have the greatest impact. Active money tends to act a little bit like closet indexers. And then, of course, in the background, you have those derivative strategies, and you have pretty much a constant fast trading influence. But look at what was happening here. We had investor influence that was starting to weaken a little bit. We got the tariff-related pressure. Remember, from a passive investment perspective, we're basically creating inflation in the broad market. While we're creating inflation on the way up, what happens on the way down? Well, that money's got to come back out. So we see that passive money coming back out on the way down. We get through some of the tariff related drama. Passive money comes back in a big way. So does active money. We continue to get that upside, but that support starts to weaken again. We're at a quarter two to quarter three transition. Do we get some pressure during a transition? No. What ended up happening is we got a huge surge once again of passive money, further helping to lift the broad market. I did want to share what we're seeing from a 2020 to a 2025 perspective, and you've heard me talk about this a little bit. This is what the SPY looked like in 2020. And as a general rule, will tend to stay at neutral most of the time. Think of that as kind of a large cap blend product. What we saw in 2020, we were really just hitting tens with regularity. We didn't get below neutral very often during the course of that year. If we look at what we're starting to see now in 2025, money was getting washed out there at the beginning. We hit one a couple of times. We're starting to get above neutral once again with regularity, and we're above neutral right now as well. Shorts are starting to get covered from an SPY perspective. A somewhat similar look. This is the ETF side. Let's go to the underlying stocks here for just a moment and make sure that I have the right slide. This was 2020, what we were seeing in the broad market. This was the longest stretch that we've ever been above the red line. For those new to the red line, that represents stretched or overbought conditions. There was so much money that was flooding into the market that we went above that for the longest stretch that we've ever had, or second longest, excuse me, and the greatest returns. Because of that flood of money, it raised short volume for about 3 months. Shorts and eventually got covered, and the market continued to move higher. What does it look like so far in 2025? That's the second longest stretch above that red line. That's the second greatest returns we've ever had above the red line as well. There's those higher short volumes, kind of similar to 2020, and we're just now starting to get some of that short covering. So for now, I'm going to go back and see if we have any other questions. Okay. Where's the money moving into the SPY coming from? Make sure I didn't miss anything else. Just regular inflows, Steve. Some of it comes from inflows. Some of it comes from just the ETF creation process itself. Let's see. Sorry, move back up a little bit. Brad has a question about mutual funds. He's assuming that the growth in ETFs has compressed the market for mutual funds. That's absolutely right. That active investment side of things, as an example, my former company went out of business. And you see a lot of that because it's very, very difficult to compete with ETFs. Brad had one answer for Steve. Where's the money moving into the SPY coming from? And part of Brad's answer, a lot of that money comes from 401k and pension funds that have an allocation model that pumps money into the market. And what we call, and there's a phrase for that, we call it, new month, new money. And that's exactly right, Brad, thank you. How do you pick stocks in the momentum list? Is it just setup, or is it more to do with the volatility? This is a question from Joe. How do you decide? How do you make money at 2%? Would you need a lot of shares in a $40 stock and even more in a $20 stock like SoFi? Before I go there, Joe, let me make sure I fully understand your question. How do you pick the stocks? Yeah, and how do you decide? How do you make money at 2%? Okay, let's go ahead and go to the daily screening here for a second. That out of the way. All right, so daily trading ideas. And every day, there's obviously a number of them in momentum and low volatility. What you're looking for in terms of picking out the names themselves, you're just looking to get them between the entry low and the entry high. I'll mention a couple of details that I look for when I'm going through it. And what I will do is I'll just drop them into a watch list. So this is today's volatility names. This is today's low volatility names. What I will generally do, and Tim follows a pretty similar philosophy, I'll be looking for names towards the end of the day. So for example, I picked up Lulu yesterday. I picked up CE yesterday as well. Those were stocks that were in that range at the end of the day. I was picking them up, hoping to gain 2% or more on those particular trades. I picked up about 2.7, 2.8% on CE. Lulu about 2.3, 2.4. This is just my philosophy. There's different ways of doing it. But once I get a position, whatever that position size might be, and you're correct in terms of if you're picking up a position, let's say you're picking up a $5,000 position in SoFi, that's going to be greater. It's going to be a greater amount of shares than in IONQ. Roughly half. So what I will do then is I will just take half of my profits at 2%. And if possible, I'll let the other half run for a little while and try to make a little bit more money on some of those. One thing that you will notice with some of the momentum names is when they catch fire, they catch fire. SoFi's been up, 2 days in a row, big amounts. The low volatility portfolio, as a general rule, won't tend to have the same type of upside. You're looking to make 1% in those names. As a general rule, you're trying to make about 2% in the momentum names. But what I will usually do then is I will just look at the names towards the end of the day. And if I'm looking at RYTM, just as an example, I might pull it up and look for news in the name. If I can put it up right. So here's the trading today, down about 20 basis points. I'll just do a real quick scan. Am I seeing any news that might prevent me from perhaps owning, Rhythm today? And I'll do a more kind of thorough look later, but that's part of what I'm looking for. Let's say that Rhythm, instead of being down 20 basis points, let's say it was down 4%. And it was down. There was news in the name, and it was trading 1.5 times the amount of what it normally trades. I would probably avoid that one. I tend to avoid things that have news, and I tend to avoid stocks that have real heavy volume if I'm trying to pick up something that's down a little bit, just as an example. Hopefully that explained part of it. Brad makes a comment about financial advisors who've been in the market since 2000. Yes, very difficult to beat the S&P 500. There's obviously inherent advantages there, much less expensive to pick up the SPY than it is to be an active manager. It just goes against you if you're charging, let's call it 70 basis points, and you get into the SPY for 6 basis points. There's obviously 65 basis points already working against you. Trevor has a question about how do you get into long S&P, short S&P, and volatility trades? So great question, Trevor. Let's make sure I share my screen again. Let's go back to the platform for a second and try to look at a couple of examples there. As a general rule, it's easier to go long than it is to go short. And part of the reason for that is what we just looked at with ETFs. ETFs have that inflationary effect that over time, all things being equal, the market tends to move higher. And it is a little bit more difficult to go short the market. So if we were looking at points where you would go in on a leveraged long trade, when sentiment dips below the green line, that's an incredible opportunity to leverage in from a long position. You see that happens. This is a 1-year chart. It occurs about 3 or 4 times a year. It doesn't occur very often, but it's generally a very, very good entry point. Other things that you could consider. Here's an example here where sentiment got below 5. We never got to the green line, but we stopped falling. You could potentially set that up as a leveraged long, especially if short volume is low at the same time. But generally speaking, you're looking for divergence. And from a broad market perspective, once again, the best entry points are below the green line. And ideally, if short volume, you can see short volume was low here at the same time, and the market just ripped higher. In terms of points where you can short the market, recognize that they're difficult. You're looking for convergence, so that you're looking for declining sentiment, and you're looking for short volume that's moving higher. If we look back at April trading, see if that was an example. Obviously, sentiment is falling. Some of the returns where you really start to make money on the short side is once sentiment moves below 5 and before it gets to 4. Now, if the market falls apart, there's going to be additional room for a short period of time. You can see that happened there with that tariff uncertainty. But that's generally what you're looking for. It's easier to make money going long. The windows for going short tend to be a little shorter from a broad market perspective. You can set up, and I'll just do a screenshot here. You can set up individual short portfolios. I'll just do a quick screenshot with 2 of them here if you want to look at them. One of them, my friend Barry, this particular one looks at companies that are slipping from high sentiment levels. So in other words, sentiment in this particular portfolio is slipping from 9. It's been a high riser. Everything's been going great. Sentiment is now starting to slide from very high levels. The other portfolio on an individual basis that I have, similar concept to that other one. This one is looking at sentiment that is starting to slide below 4. So it's 2 very different approaches. One is kind of catching those high flyers. This one's catching those that have already been under some pressure and are likely to continue to come under pressure. In terms of volatility itself, it's a difficult trade. And let me share with you an example of how I approach it. I don't do this trade very often. It's basically about once every 6 weeks as a general rule. What I'm sharing with you is UVXY, and I'll share with you what happens to this one over time. This was, just the damage that was done with the tariff uncertainty and everything back in April. The general rule for this type of volatility trade, it's very fast. You'll make 10 or 15%. It's hard to tell because this was such a huge move, but you can make 10 or 15% in a couple of days. and then you need to get out because that low volatility trade will once again kind of take over. And you can see how that, plays out. It's up, moves back down. You can see how low it is right now. And perhaps I'll address that here for just a moment. Perhaps we're approaching a similar time frame where volatility is getting washed out of the market. Take a peek here at what's happening with the SPY. Recognize that normal volatility, 1.2, 1.3%, we're now down to 70 basis points. So everyone's piling on to the same trade right now, that low volatility trade. It probably means that we have some type of volatility episode coming up. It's just always hard to pick the exact day when that's going to occur. So that's the difficulty with going into with betting on volatility. It's just difficult to find the exact day. When you get it right, it can be 10, 15%. If you look at that trade, that was 30, 40, 50%. Obviously, it doesn't happen very often. Hopefully that helps to address that question. Why do I pick and place trades at the end of the day? It's the reference price, Brad, at the end of the day. And then I'm just looking to, a lot of times you'll see movement, that 2%, I made 2 to 3% in 3 different names this morning, and I made it within the first couple of hours of the trading day. So if it works out well, you're getting things that are on sale at the end of the day, and then you're being able to profit. Why are you being able to profit? Because you have very good sentiment indicators, and you have divergence, and you have divergence total, but you have good sentiment, and you have lower short volume. We've already talked a little bit about some of the daily trading. Let me go ahead and go to what I see as perhaps the path ahead. It's always a little bit tricky, but if we look at where we're at right now, and part of this plays into derivatives positioning. If we look at what market participants are doing right now, and I'll back this up a little bit. So options expirations cycle, let's say that you establish positions in the market, shortly afterwards. What have we seen? Well, for the most part, we've seen gains. What are market participants going to do? Well, they're going to hold on to those gains, probably into expirations or close to expirations. And this is the first part to consider. If you look at expirations back in June, it's a great example. What did we see for a period of time? Well, we saw gains in the SPY. What did we get during expirations itself? I think we got a little bit of profit taking. So that's the concern here as we go into expirations next week. Very nice run. Could we see a little bit of profit taking? It's certainly a very, distinct possibility. At some point, could we see a volatility event? I shared with you what's happening in the SPY right now, that volatility is kind of going out of it. Let me share one thing that Tim has shared before. What you're looking at here is the SPY over time. This is 2020. This is currently. What do you see that's a difference between the two? Well, you see a number of volatility events associated with that downside, before the market really started to lift. What do we see here? We just basically see one volatility event. And I captured this information in a slightly different way here. So this is 2020. You can see that number of volatility events that occurred. This is this year. So, very, very different. This is very normal where you'll continue to see volatility for a period of time. It basically just got completely washed out. Do we get another volatility event? Probably. When does it occur? That's what we don't know, but that's something that that we're certainly watching. Let me share one other item coming up next week. It has to do with the big banks. So just as a reminder, moving higher probably till close to expirations next week. Watch out for potential profit taking. Next week itself, the big banks also start to report. And one way that I look at them is I've set up a portfolio just with the larger companies. And what you can do with this is just set up a sector portfolio and then just screen by market cap and just grab the big guys. So that's what I did here. And if you look at the setup right now, I think it's next Tuesday or Wednesday when the big banks start to report. Sentiment right now, 8 out of 10. Very, very, very strong. Starting to slip just a little bit, but that's a very good number. We can see that shorts have been getting covered. If the big banks were starting to report tomorrow, we would say this is a great setup. And obviously we'll have to wait till next week, but that would be probably a bullish look going into that reporting cycle. I think that's some of the main. Oh, and one other item. I found this one fascinating. Earlier in the day today, I don't know if you noticed, but the small caps were doing a little bit better. Take a look at what small caps are doing right now. So small cap portfolio, strong demand, moving higher over time. Look at that short covering, really strong short covering. Big tech was struggling a little bit this morning. What's the setup right now for big tech? Well, sentiment starting to fade a little bit, short volume just starting to move higher. So just a good example of how predictive sometimes market structure edge can be. I really found that fascinating with small cap this morning. And we've kind of come to the end of our time. Let's see, Candace, let's see if we can address your question. Candace, looking for divergence in names that aren't in the daily trading ideas. Yes, we don't see a probability. Is there anything cautionary we need to know for names that don't show a probability? Sometimes what I'll do for those, and maybe I'll just give an example here. And let's just look at IONQ just because I had it up. I will sometimes look back over time, and let's say that you just happen to pick out a name, and this is from our momentum portfolio, but let's say this was just a name that you were looking at. And I wouldn't go back much more than about 6 months, but go back about 6 months or so and look at what it's done in a similar environment. So IONQ, when it hits 10, what does it tend to do? It tends to be a pretty good indicator that, you're going to be getting some upside. Once it falls out of 10, what happens? Well, it tends to fall apart, right? So it can give you an idea if you're looking at, buying a name, hey, what happens when it starts to rise above neutral? What happens when it hits 10? What happens when it rises from fully oversold? I would just recommend going back in time and taking a peek at that. One other way that you could do that is you could just set it up on what we call the profiler. And you can go and look at that. And let's say that you want to buy when it's 5, you want to sell when it goes back below 5. And you can look for periods of time. What has it done in the past? Is that something that I would want to consider? What has it done in the most recent cycle? And you can see what this one's doing. It's, generally been on fire. But that's kind of 2 different ways that you could approach that. One is through the profiler itself. You can set up your own profiler there. Maybe you want to buy when it goes above 6, sell when it goes below 5, whatever it might be. Or as I mentioned, you could go back and just check it during the last 6 months or so and, see what normal trading is under those conditions. Brad, edge is we get the data every day. I believe it's 2 a.m. Mountain Time is when we updated. So, guys, thank you for the questions today. I really appreciate it. Hopefully, it was of help to you. I know some of it was a little bit more classroom orientation, but it's important that we understand the basics of the market because it obviously has a huge impact on us as traders. So with that, I'll let you guys go. Great to see everyone, and we hope to see